Hey, how you guys doing tonight? Lone Dude here. I have the opportunity to talk to you guys about why the heck would I refinance in the current market? And I get this question a lot going on right now, and everyone always says, I have a great interest rate. Well, that may be the case, but there's a lot of other things you guys can do with the refinance other than just getting a lower rate. And so today I'm going to talk with you guys about some different options that are out there right now with potentially your property or what you may own right now. Okay, so I'm just going to get started. Now, we're going to start with rates. And, interest rates today are 5.625 on the 30-year fixed. I've been doing loans for multiple decades. And when I first started, the average rate was about 8%. That was pretty common. And through time, as we've notched down, a point over the years, 7%, 6%, and so on and so forth. At the time, based on where we were with rates, people didn't think they'd ever get any lower. I remember when rates got to about 6%, it was probably in 2005, 2006 era, and we didn't think rates would ever get any lower than that. And so there was a flurry of people to do refinances, purchases, things at that time, specifically based off a 6% interest rate. So us being today at a 5.625 is still lower than what history shows us over time. And, people who have been born millennials or people who have been born in the last it's called generation of time that you have never seen interest rates this low. And it's not that interest rates weren't high. It's just at that time you weren't mortgage ready or in the market to buy a house. So I promise you when you were growing up, interest rates were potentially higher than they are today. And so with where rates are right now and the Fed's announcing this last week that they're going to continue to raise them, I think we're in for it, and I don't think this is going to change anytime soon. I think, maybe in 2023, they're predicting rates may drop down to 5%, something like that, and we may be there. But again, we're not there right now. And so to give you a perspective on interest rates in general, since January 1st to this time of this year, we've gone up a full 2.5 points in rate, which is the largest rise in interest rates in the shortest amount of time since we've been tracking interest rates. And so, yeah, interest rates have definitely gone up this year, but again, over history or historically, they're still relatively low in comparison. Okay. Now, one of the things that I hear a lot of right now is the R word, recession. And people generally think that recession means that your house is going to go down or you're going to lose value in your property. And that is potentially, that could possibly be the case. However, if you look what history shows us here, over the last 6 recessions, 4 of those 6, housing prices have actually gone up. And so don't be confused by the word recession and what that means and how that impacts your property value, okay? And so if you guys look as recent as 2020, during the time, or 2020, the time of that recession, housing prices actually went up 6% that year relative. So, just because you hear the R word or the word recession, don't bat an eye or think specifically that means that somehow your housing price is going to be impacted or dip down. Now, homeownership is a hedge against inflation, and this is a great statistic, and this shows that, even as recent as 2021, when inflation was at 6.8%, housing prices outpaced that by almost a full 12% in equity being gained in a property. So you homeowners who are on here tonight, recognize that owning a house is a great asset and a great tool to have and great potentially for your retirement, things of that nature. And so I really wanted to show you guys how home ownership can help you hedge against inflation simply by paying your mortgage on time. All right. So now, why the heck would I refinance? And we're going to go over a couple different examples of why you would refinance, and then we're going to give some monetary examples showing you guys, real life examples of what it did for different individuals. The first thing is to take advantage of the increased home values, just like I was showing you in one of those previous charts about how much equity people have gained, let's call it in the last 5 years. They say the average homeowner in California over the last 5 years of time who has paid their mortgage on time has accumulated over $200,000 in equitable wealth on their property. And again, that's just by you paying your mortgage on time. I always remind people that if you're renting, you're paying 100% is your mortgage rate or your interest rate on your rental. Okay, so if you're renting right now, your interest rate is 100%. So people who own a property, you people who own properties out there, take advantage of the equity right now, okay? If you're going to sleep at night and you have, X amount, let's say $500,000 equity in your property, that equity only does something for you if you go to sell the property, okay? So if you're laying there at night and you're broke, or you have a bunch of debts accumulating, or you want to do an expansion or an addition on your property, again, you have an advantage that you're not really considering of accessing or tapping that equity in your property, okay? Cash out can be used for different things: debt consolidations, home additions, home purchases, things of that nature, but take advantage of the increased home values that you have right now. Okay. Because of your home equity, you may have the ability to remove your mortgage insurance. Okay. And so a lot of people, when they buy houses, they're typically buying with an FHA loan, because FHA loans are such a small down payment. And FHA does require you to have mortgage insurance. Before 2012, if you had an FHA loan, you had the ability to get mortgage insurance removed on your property after 10 years. Now, after the new law was passed in 2012, PMI or mortgage insurance is on your property for all 30 years if you have an FHA loan. Doesn't matter how much equity you have. So if you have a $400,000 mortgage and your house is worth $800,000, you don't get to get PMI removed if you have FHA loan. Again, it's on you for the life of the loan. And people who have larger FHA loans, sometimes that PMI payment can translate to $500 to $700 a month in payment, which is a substantial amount that you're paying to that goes absolutely to nothing. Okay, you guys are paying for the mortgage insurance in case you default on the loan. That's what that's for. Again, it's not a benefit to you, I promise. Maybe you have an FHA, VA, or USDA loan. In these instances, we can do what are called streamline loans. Now, how a streamline refinance works is the new payment. In this instance, your interest rate, you do have to have a lower interest rate typically. You have to improve your total monthly payment by at least 5% to qualify for a streamline loan, and you have to have made your last 12 mortgage payments on time, no forbearances. Okay, so the last 12 consecutive mortgage payments have to be made on time. We will check your credit on these streamlines. However, there's no appraisal and no income documentations on this product. And so if there's an opportunity, maybe you got an FHA loan in the last year or two and your rate is higher than rates are today, then this might be a product that we could look at for you. And again, a streamline refinance, no appraisal, no income documentations. We specifically go off your credit score and your payment history. I'm going to get into some examples now, some monetary examples of some of the things we just talked about. The first one we're going to go over is a debt consolidation loan, someone taking cash out to pay off debts. Okay, this is a really, really, really common thing right now. And the irony of this is people have bought houses in the last few years and they have great rates. And when I talk to people, they do not want to touch that rate with a 10-foot pole. However, on the other side of this, they're accumulating a ton of credit card debt, installment debt. Maybe they're taking out personal loans. Maybe they want to pay off student loans, car debts, things of that nature. Now, one of the things I wanted to show you on this debt consolidation example is when you have so you have a credit card. The average interest rate on a credit card right now in the United States is 24%. Okay, and when you have, let's say, 3 or 4 credit cards at 24%, and maybe the average balance of it is $5,000. That, understand your minimum payments that you're paying every month. You're not paying typically any principal amount on that debt. And so you're usually paying interest only on those payments. And so this is a great example right here. I had a client who had a 3.5 interest rate. They already had a conventional loan, so they didn't need to remove PMI or anything like that. Came to me, they had a ton of debt. And their issue specifically is that at the end of the month, they had no money left. They were literally broke. And so they came to me to see, again, if we could lower rate. And that's what they talked about first. But once I got in and was able to see all the debt they were carrying, I showed them that right now, their monthly outgoing is almost $3,000 a month. Yes, their interest rate is great and their monthly payment on their mortgage is great. But once you add in the minimum payments on those credit cards, again, the minimum payments that are paying off any of the principal balance or debts, they were paying almost $3,000 a month. So we took out $40,000. We paid off this debt. And their new interest rate was 5.125, which again is higher than the 3.5 they had. The new payment is $21.24, so they're paying about $600 more a month on the mortgage payment than they were paying before. But here's the big but. Prior to that, they had $41,000 in credit card debt. We paid off all of their credit card debt. So they literally had, when we were done with this transaction, they had no debt at all except for their mortgage. So they were saving on outgoing money, they were saving $795 a month, which is awesome. So it freed up some money. Now here's a little caveat to that, is that if we took that $795 and added it back into the new mortgage that they had, okay, so again, we're not changing anything outgoing from what they had prior, they're able to pay off this 30-year mortgage in 17 years, okay? Again, not by doing anything different, but by moving the money around. And so with that 17 years being paid off, they're saving over $185,000 in total interest paid over the life of their loan. And again, they had a 3.5% rate. The new rate is over 5%, but we're paying off all of the other debt that they've accumulated with credit cards, okay? So this is a prime example to look at this through a different set of lenses when you're thinking about why the heck would I refinance right now, okay? So again, if you're carrying, let's call it over $20,000 to $25,000 in revolving debt, I would strongly encourage you to look into a refinance and see what it may do to you and again, your bottom line at the end of the month. Next example I'm going to go over is cash out for home improvements or home purchases, okay? And so in this instance, what seems to be happening a lot in the last few years is everybody wants to sell their house because they feel like they can get, the highest dollar amount fetched for what they owe. What happens is, though, when they really start looking at what they can do with that money, all of a sudden they're taking all this equity they got from this house and then they're going and buying exactly the same house that they live in already. So they're not necessarily buying anything bigger because housing prices have gone up so much and interest rates have gone up so much. So a lot of times what starts happening in the last few years is people look at this and then they pull back and they say, I don't want to move right now. But the opportunity they have is because they have so much equity in their house, let's expand or rehab that house. Maybe we need a new kitchen, maybe we need new bathrooms, things that will do something to feel like you're maybe getting a new house, but even though you aren't. Okay, this example I have on here is someone who wanted to add an office to their house. So this person is self-employed. They have an office somewhere that they're paying X amount of dollars a month for, and they had the idea of building an office in the back of their house. And now their business rents that office. So theoretically, their business, which was already paying rent somewhere else, is now paying rent to themselves as a homeowner, which now covers their entire mortgage. So you see, they're paying the same amount of money as they were before, but now they're paying it to themselves because they're the owners, they're the landlord of that building or that office that they built behind their house. So it added about 600 square feet of value to them. Their previous interest rate was 4.125. They took out $150,000 to build this unit on the back. Their mortgage payment went up by about $1,200 a month. But remember what I was telling you, now they're collecting rent from themselves, which easily covers that difference. They're actually collecting $2,000 a month in rent from their own business that's renting that office in the back of their house. So now they're cash flowing on top of that. Now, the home value went up from $600,000 before they did this addition in the back. Now the value on their house is worth $875,000. So it went up $275,000 in value by adding this to the back of their house. So again, there's some different things to think about when you think about why the heck would I refinance right now? Maybe you're self-employed, maybe you have a business, maybe you want to add an ADU to the back. Maybe you have some relatives, maybe you're multi-generational where you want to move your kids and your grandkids into your house. And this would be an opportunity to expand and do something like that. Again, tapping the equity that you're already sleeping on in the house and utilizing it to improve the situation that you're already living in. Now, a couple other things you guys could do with some of this cash out is you guys could buy another house, okay? Housing prices have cooled in the last few months, and there's going to be some real great investment opportunities here as we turn the corner. So maybe you take out $150,000, now you have a down payment to buy another house where you're renting out and now you're cash flowing off of that. Again, you're building equity by buying more properties with this stuff. Another prime example that we've gone through a lot the last few years of people refinancing specifically to remove a spouse or someone else from their loan and their property. If you get a divorce and you guys are both on the title and both on the mortgage of the house, typically you'll have to do a refinance to get the other person off of that. And so this would be another example of why the heck you do a refinance right now. Removing someone else from the property. So maybe removing, again, an ex-spouse or an ex-partner from your current situation. Oh, I missed that one. Okay, So this one is switching from a conventional loan, or switching from an FHA to conventional loan. As I was talking about before, a lot of people who are first-time homebuyers more often than not are using FHA loans to purchase the house. And the reason specifically is an FHA loan is the most conducive to lower credit scores, to higher debt to income ratios, things of that nature. So it's like the low-hanging fruit of loans, okay? FHA loans are more in terms of the simplest for us to get you across the finish line here as far as purchasing a property. What comes along with FHA loans, like I highlighted earlier, is you have PMI for all 30 years of the loan, okay? And again, your PMI is a payment that you're paying technically to nothing, and you don't get any tax credits or deductions for paying that PMI. And so this person came to me, they had a 3.875 FHA loan. The new rate was going to be 4.99, which is higher. I recognize that. Now, once you remove the PMI, their monthly payment dropped by $58 a month, which again, when I hear you saying that that's nothing, that's a couple of your Starbucks every month. However, when I translate that $58 over the life of 25 years of the difference of the loans, this person had been in that FHA loan for 5 years, that's a total saving of $17,400, which is real cash. And so don't think so short term of, if I'm only saving $58 a month for the next couple of years, well, if you're going to sell your property in the next couple of years, then don't do a refinance to move the PMI. But if you're going to be in your property long term, as you can see, even saving a little bit off your PMI translates to a very large amount over time. So again, think long term with these types of things. Okay, so that would be another reason why I would encourage you to look into potentially refinancing right now, is again to remove your PMI from your FHA loan. And this is done specifically because of the equity that's been built in your property in the last chunk of years. All right, so now we're going to talk about the refinance process. And so the refinance process typically takes about 30 days from start to finish to complete. We are going to take an application with you. We're going to pull your credit. Now, if we are doing a Fannie Mae or Freddie Mac type of loan, we're going to look at the 2 last years of your income history. So we're going to ask for 2 years tax returns, 2 years W-2s, and your last 30 days of pay stubs. Okay, real basic stuff there. Now, as far as credit scores to do a refinance, to do an FHA refinance, you need at least a 580 credit score, okay, for an FHA or VA loan. And for a conventional loan, you need at least a 620 credit score. Okay, so those are the minimums that are required when we're doing loans for you guys and that stuff. Okay, we submit your loan to underwriting. We'll receive a loan approval. We will, in some cases, have to order an appraisal. If you're doing a refinance and accessing equity or doing cash out, about 50% of the time, we're going to require an appraisal done. Okay, if you're doing a loan just to lower your payment or remove a spouse or something of that nature, typically appraisals aren't required anymore with those types of things. And I say typically, but that is not guaranteed by any means. Okay. Then we get your final approval. Then we go to loan closing. Again, this process from start to finish takes about 30 days to complete. Okay. Now, I wanted to touch on this real quick. This is alternative income styles because, like I said before, if you're doing a Fannie Mae or Freddie Mac type of loan, we need 2 years of your income stuff, tax returns, W-2s, and then your last 30 days of pay stubs. However, I am a broker and I'm licensed with over 140 lenders in California. So there's a bunch of different types of loans I can do or different types of incomes that we can validate to do loans for you. One of those things is called bank statement loans, okay? If you are self-employed, which you have to be self-employed for this product, we can go off the last 12 or 24 months of your personal or business bank statement deposits, and then we divide it by that amount of months. That's the income we use. So if you're in a service profession and you're receiving lots and lots of Venmo, PayPal, cash deposits, things of that nature from your business, that might be the route for us to go to look at income for you versus going off tax returns. All of us self-employed people, I'm one of them. We all want to make a lot of money, but none of us want to report that to Uncle Sam. So when we all go to buy houses or do things like you guys are trying to do, we have challenges with that as well because, again, our tax returns don't look like the income that we technically or typically make. So bank statement loans are a great product for people who are loan officers, people, real estate agents, again, people who are self-employed in some type of service entity or service business, okay? So that's one of the products I can use as an alternative income type. The second one is, say you're in sales and you've gotten a really good 1099 this last year. And again, Fannie, Freddie, we go off 2 years. This product, I can go off your 1 year of your 1099. So I'll go off your most recent 1099 year. That's the income we qualify you with. We divide it by 12. That's the income that we use, okay? So again, if you're trying to do a refinance and you're a 1099 employee and you had one really good year this last year, that might be a different way we can get from point A to point B. Okay. The next product I have available is what's called a P&L, and this is, you have to be self-employed. I need a year-to-date profit and loss, and then I need your last 3 months bank statements. Now, the last 3 months bank statements you give me have to match the deposits coming into those bank statements of how your P&L looks. Okay. And so again, if you're self-employed and you've had a great quarter or a great year so far, this might be a different alternative for us to generate some income for you or show you and allow you to qualify to do a refinance on your property. Okay. The last one I have is what these loans are called DSCR loans, and these loans are based off these are for investment properties only. Okay. And these are specifically based off the rental income that you are collecting or that you will be collecting. Okay. The only two things we check on this is we check your credit score and we check that there is a lease or there will be a potential lease. That is all we check on these loans. Okay. These types of products right now allow you to get up to 75% cash out on these investment products. So if you're an investor, you have a house and you're not showing any income, or your income is really low on your tax returns, this would be an amazing product for you to look into and use. And again, this is specifically designed for investment properties. And so if your income doesn't look the way you feel like it needs to look to qualify for a refinance, please don't hesitate to reach out to me, because there are some different things I can show you that we might be able to show more income on paper than you think you actually make via taxes. Okay. Last thing I wanted to focus on was credit. Now, credit is a very important thing, and credit is the barometer in how we measure a lot of things when we do a loan. You know, what is your credit score? What is your FICO score? That dictates your interest rate, and it dictates what different types of programs are available to you in the lending world. So on here, I have a company that I use, Blue Water Credit Repair. They are an awesome company. They're a local company up here in Sacramento area. I was one of their first clients over 15 years ago. And so I can speak to the truth that I have used them myself, and they are truly awesome. And so if you do have some credit challenges and you need some help on your credit, please reach out to me or reach out to Kara Dukes. I have her information here, and she would gladly take you in and help you fix your credit and get you to where you need to be for your home purchase or refinance. Now, I also have a website on here, annualcreditreport.com, where you can go log on there and fill out a form, and you can get a free copy of your credit report today. Okay. Here's all my information. Please scan my QR code if you would like to set up an appointment with me. I do have all my social media tags on there as well. And I really want to thank you guys for coming in tonight, for spending the time with me and learning why the heck you would refinance in this current market. And so thank you guys for coming in tonight, and I look forward to working with you guys in the future. Stay cool out there.